Good day, ladies and gentlemen. Welcome to this session. Assalamu alaikum wa rahmatullahi wa barakatuh. My name is Mujtaba Khalid. I'm heading the Islamic Finance Center at the Bahrain Institute of Banking and Finance, which is the training arm of the Central Bank of Bahrain. The Islamic Finance Center at BIBF is the oldest Islamic finance professional qualification provider in the world, being set up in 1997. So today we're going to discuss Islamic finance and reaping its economic benefits, especially its macroeconomic benefits, which is an interesting topic. I'd also like to thank AIFC and for inviting me for Islamic Finance Week. I mean, some of the initiatives by the AIFC are amazing, and I'd like to congratulate Kazakhstan. Their president just announced a $300 million sukuk to be issued by next year. So the Islamic finance industry is about 3 decades old now. And over the past decade, it's seen considerable growth, especially if you factor in that the world has seen a financial crisis, but the Islamic finance industry has seen almost double-digit growth year on year. I mean, currently it's valued at about $2 trillion roughly, and according to Thomson Reuters, by 2020 it's going to reach $3 trillion, which is a 50% increase. According to other sources, it might even reach $6 trillion, which is 100%, more than 100% jump. So there is work in the Islamic finance industry. So the Islamic finance industry is at a growth stage. If we go away from the numbers and if you look at the evolution of the Islamic finance industry, we're at this stage which I like to call the third inflection of the industry. In the 60s or 70s, we had the first evolution of the first Islamic bank set up, and that was the first stage. Can there be something called an Islamic bank? And especially if we put ourselves back then, where all banks were interest-bearing and banks were known to be interest-bearing entities, this was a challenge for people who were setting it up. But this was overcome. The second stage came around the 90s, right, which was scalability. Right? How do we expand the consumer base? How do we expand the product base? And this was mostly in Muslim countries, but this was also tackled in the 90s, late 90s, early 2000s. But scalability was also an issue which has been addressed to an extent. And now, currently, we are at the third stage of the evolution of Islamic finance, which is the global value proposition for Islamic finance. So we've seen that in Islamic countries, in Muslim majority countries, Islamic finance has worked, I mean, to a certain extent. But what is the value proposition, the global value proposition for Islamic finance? And this is the next challenge for the industry. And if you look at it, it's not more of a challenge, it's how we approach it. Because Islamic finance is already based on socially responsible principles, social justice, ethical finance. I mean, in Islamic finance, we're not allowed to invest in investments or businesses which cause social harm. For example, alcohol, tobacco, weapons, and such. So there is definitely a value proposition, a global value proposition, especially if you look at the fact that over the past decade, if not more, something else has been gaining momentum, which is SRIs, socially responsible investments, ESGs, ethical-based services, ethical and governance-based services. So there's definite value proposition if we also factor in the maqasid al-sharia, the tenets of Islamic finance, if you may. So that's from an evolutionary point, that's where we are. And that also makes business sense, right? If we look at this graph, which we're showing on your screen, this shows the equity market performance from 2001 to 2015 of the US market, right? And you see three lines here. And what I've tried to show here is, if you look at the middle line, the light gray one, that shows the return year on year of the S&P 500, which is the market index. And if you look at it, the SRI equal weighted average, the socially responsible investment average, has outperformed the index over this period. So there is definitely also a business case for this, for ethical finance. It's just not like a feel-good thing. There's also definitely a business case as well. Right. So when we speak of Islamic finance, and we try to speak of it in very general, easy to understand terms, Islamic economic theory has three aspects, right? There should be real economic activity, right? So there should be an underlying asset or economic activity. If I want to, as a business, if I want a loan, or if I need money or liquidity, I go to one of the ways I can do that. I go to an Islamic bank, and the bank may go into a partnership with me. So there's underlying real economic activity. There can be a real asset. So for example, I need a commodity input, raw material for my business. I go to an Islamic bank. The Islamic bank buys the raw material and then sells it to me at a premium. We'll go into more detail on what these are, what these contracts are. So there's real underlying economic activity. The second is risk sharing. So in Islamic finance, you have to, and this comes into under social justice, you have to take risk, you have to have skin in the game to reap a reward. Right? What does that mean? So if I go to a conventional bank, right, I deposit my money. I have excess money. I deposit my money with the bank, and this is a conventional interest-bearing bank, and suppose I put $100 with the bank. And the bank says after 6 months you'll get 10% interest. The interest rate is 10% for 6 months, and after 6 months you will get 10%. So after 6 months, I will get what do you call 110, right? The bank will have to guarantee this amount. And this is where social justice comes, the aspect of social justice comes in as well. If I go to an Islamic bank, or if it's a partnership model, for example, I go to a bank, I deposit $100 with the bank, and suppose the bank makes $10 profit, right? We go into partnership, the bank makes $10 profit. So we decided that the profit will be shared half and half, 50-50. So if the bank's made $10 profit, then my share is $5, the bank's share is $5. But if the bank has made $100 profit, right, my share is $50 and the bank's share is $50. So there's social justice. So I've taken risk. On the flip side, if there's loss, me as a depositor, I have to take the hit. Now we can argue if this happens really or not, but those are, what we're talking about is economic theory, Islamic economic theory. And last, but certainly not least, is social justice. You know, like we mentioned earlier, social responsible investments and social justice. So this is just to give you an overview of Islamic economic theory and what it means. Now, if we delve deeper into it, you know, in understanding Islamic financial principles, you know, we start off with the general principles of Islamic contracts. The first and foremost is free mutual consent. Right? So you cannot force someone into entering a contract by force. Right? They have to have free mutual consent. You have to have free mutual consent. So the first is free mutual consent. The second, prohibition of riba. Now riba, if I translate it into English, loosely it means prohibition of interest. Right? And riba is a very interesting and complex topic. But if I'm generally going to explain it, and there's books and books written and papers written on this, but generally just to explain for time's sake, anything which you know, creates money over money or due to time will be called interest. So example, again, like I go to a bank, I put $100, the bank says the interest rate is 10. After 6 months, it gives me 110, right? So the $10 interest. That's riba, just to explain in general terms. Prohibition of gharar. Now gharar means uncertainty. Uncertainty in a contract, uncertainty in the outcome of a contract. For example, someone comes to me and says, I'll sell to you the fish in the sea, right? Now, is that a certainty? Firstly, you don't know how many fishes are in the sea. Secondly, you're not certain if you can catch all the fish in the sea. And this is a general example just to explain my point. So uncertainty in Islamic contracts, you should be certain of the outcome, and there should be certainty in the dealings or how it should be done, right? And lastly, prohibition of maisir. Maisir means gambling. In financial terms, excessive speculation, right? So these are four, and so for example, you know, I gave this example earlier in a lecture. For example, Bitcoin, right? Now, Bitcoin in itself, I'm not saying if it's permissible or not permissible, but currently, does anyone know what the value of Bitcoin will be? Will it go down? Will it go up? You know, what are the fundamentals? I don't think, personally, from my understanding, I certainly don't think anyone can predict at the moment where Bitcoin will be. So that's speculation. If someone invests into it, that's more speculation than a sound financial, understanding of the matter. So these are the 4 general principles, easy to, condensed into very easy to understand language of an Islamic contract. When we go into the classification of Islamic contracts, again, just to give you an idea, obviously these are more detailed topics, but if we go into in the classification of Islamic financial contracts, there are 4 main types of Islamic financial contracts. Partnership models, partnership-based contracts, exchange-based contracts, charitable contracts, and security contracts, right? So for example, in partnership, you've got 2 important contracts. One is a mudaraba and one is a musharaka. A mudaraba is a venture capital contract. So for example, you've got a capital provider and you've got an entrepreneur. The capital provider gives his money to the entrepreneur. The entrepreneur has a business idea, he invests in a business, and when the profits are shared according to a predetermined profit sharing ratio, right? One thing which you can do, and is important to note in these partnership based contracts, is you cannot stipulate that after, for example, 1 year, I will get $1,000 guaranteed, right? That would make it riba, non-permissible. What you can say is, we will share the profit according to whatever ratios we decide to. So for example, if I make a profit of 10, and we've decided the profit sharing ratio is again 50-50, so 5-5 is shared between me, the capital provider, and the entrepreneur. If the profit is 100, then again 50-50, and if profit is 1,000, then 500-500, right? This is a mudaraba contract. In a mudaraba, however, if there's loss, that is going to be, the capital provider will take the hit of the loss, right? Unless there is proven negligence against the entrepreneur. So if the entrepreneur is negligent, right, who's called the mudarib. So the capital provider is called the Rabbul Mal, the entrepreneur is called the mudarib. If we can prove that the mudarib has been negligent in his duties, then obviously the capital provider can say, no, you were negligent, you will have to reimburse me for the loss. The second partnership contract is a musharaka. A musharaka is a general partnership where 2 or more than 2 partners, put in money or other like enterprise or whatever, or even in certain cases raw materials or tools, depending on the type of partnership this is, and they enter into a business, right? And then obviously in the partnership deed, you have to decide the profit sharing ratio. Just like a mudaraba, here you cannot stipulate that each partner gets a fixed amount. That would again tantamount to riba. What you can say is that you can share the profit according to whatever ratio the partners decide. The loss, however, in the musharaka contract is based on the capital contribution ratio. And what do I mean by that? Right. So example, 2 people get into a musharaka contract, right? One has paid so the total capital provided is $1,000. One has paid $800. The other has paid $200 into the business venture, right? They decide, and which is allowed, that the profits will be shared 50-50, which is allowed. If both the partners agree, and if the tenets of the contracts are fulfilled, then yes, it's allowed. So the partnership decides that both the partners will distribute profit according to a 50-50 percentage. But the loss is to be distributed based on the capital contribution. So one of the parties gave $800, the other $200, so the capital contribution is 80-20. So if it's a $100 loss, the partner who gave $800 will, take a hit of $80. The other partner will take a hit of $20, right? So profit sharing according to a predetermined ratios, which can be anything. Loss sharing or loss according to the capital percentage put into the enterprise. Then we have exchange-based contracts. Now again, exchange-based contracts, there are a lot, but I'll just give example of one of them, which is one of the most used ones, which is a murabaha. Now a murabaha is a contract which basically is a cost plus markup sale contract. What does that mean? So I need a commodity. My business needs a commodity. I'm an airline, for example, or any other industry, and I need raw material. As I discussed earlier, I go to the bank buys the raw material, right, and sells it to me at a markup. So if the bank buys it at 100 in the market, sells it to me at a 120 rate, for example. And the bank says you can pay me back in 6 months or a year. Now you can pay back lump sum after 1 year, or you can stagger the payment. So every year, every month, you can pay $20 till 1 year, right, for $120. Now here the question arises, what is the difference between this and if I, or an interest-bearing transaction, right? Even in an interest-bearing transaction, I go to a bank, the bank gives me money, and after like 6 months or 12 months, I pay the bank back with a increased amount. And this is a question that's been asked before as well. And the difference here is that, one, in an Islamic contract, the bank actually owns the asset. So the ownership risk has been taken by the bank. So for example, if the bank buys the asset, if it's oil, for example, right, and it sells it to me, but between that, the price of oil drops significantly or increases significantly, right? So as a bank, I would have to take a hit for that increase. So there is risk involved. The bank is taking risk, right? This is the difference between if someone asks, what's the difference between a conventional, transaction on these basis and Islamic, this is the underlying. So you've got an underlying asset, A. B, you've taken underlying risk of the asset ownership, right, as a bank, or even as an institution. The next type of contracts are charitable contracts. And one of the most used charitable contracts, which I'll discuss, is hiba. Now hiba, if we translate it into English, it means gift. And where is hiba used in Islamic finance, Islamic banking and finance? It's mostly used as when by banks, Islamic banks, to give gifts to depositors. So for example, I'm a depositor, I go to an Islamic bank, and after every year, the bank may or may not give me a gift. This can be monetary, or this can be in real physical form, right? And where does this stem from? So this stems from the fact that when the Prophet, peace be upon him, said, when someone gives you money or lends you money, you return the money in a beautiful manner, right? So that's where this the hiba concept of hiba comes from. However, the important thing to note is, contractually, you cannot say that after every 6 months or 10 or 1 year, I will give the depositor a hiba of this amount. That would again tantamount to riba. Hiba is discretionary, on the behest of the bank, and the bank may or may not opt to give a gift or a hiba to the depositor. So if it's in the opening form, when the bank depositor comes, the customer comes, and if it's mentioned that you'll be given a hiba of this percentage or whatever, no, that's Sharia non-compliant, right? And then you have security contracts, for example, collateral-based rehan contracts or whatnot, which again, I will not deal in much detail in this session. So now we move on to the interesting stuff. The potential benefits or economic benefits of Islamic finance. Are there any? And if so, what are they? Right, so if you look at the macroeconomic advantages, right, the Islamic financial system creates less leverage in a society, because there's more underlying real economic activity. There's underlying, each transaction has an underlying either economic activity or an asset, right? If you look at the 2008 financial crisis, global financial crisis, that was due to highly leveraged transactions, right? You had CDOs, and then people were packaging, mortgages. Some were good, some were bad, and packaging them into instruments, investment instruments, AAA rated investment instruments, and then selling them off. And those people are selling them off further, and then you were selling them off to other people. And then when these bad mortgages started to default, a lot of people took the hit. A lot of investors, global, both US and global investors, took a hit, right? Lehman Brothers shut down and whatnot. But in Islamic banking and finance, in an Islamic financial system, you cannot trade debt, right? Especially at a premium or a discount. Debt can be, in certain cases, can be exchanged at its monetary value, but on its face value. But you cannot make money out of trading of debt, right? So debt, in any case, cannot be, is not considered tradable in Islamic finance mostly. So you cannot trade debt. So that's not possible. That creates less leverage because you already have an underlying asset or real economic activity. Second, protection of stakeholders, because again, each transaction, theoretically speaking, must have an underlying asset or underlying real economic activity. So if there's something does go wrong, you can at least have ownership of the asset. You have ownership, physical ownership of the asset. You can sell that asset in the market, right? And you can at least redeem some of your amount. Now, having said that, is that always the case? No. Well, we've seen in certain sukuk issuances when if you delve deep into the sukuk, you realize that you don't own the asset, underlying asset, actual asset. But that's a debate for another time. This is just giving you an overview and the theoretical possibilities. Right. And probability of fewer financial crises. So linking up with the 2008 financial crisis, like I mentioned earlier. So there probability now. There's not that you can eliminate financial crises, because there have been crises in Muslim countries, right? But you can certainly limit them. Especially you can curtail leverage. So you can certainly limit them. So for example, if I look at this graph, this shows that from 2009 to 2013. Islamic economies and Islamic banks actually grew in assets. Islamic banking assets grew, right? And even most Islamic economies did grow, right? Compared to their Western counterpart, which were hit by, your financial crisis, right? So the Islamic banking assets did grow from 2009 to 2013, at the height of the financial crisis. So does that mean that Islamic banking and finance is resilient to your financial crisis? Well, it's not that straightforward a yes/no answer, and I'll tell you why. So if you go on to the next graph, right, you see during that time period, there was a super cycle of commodities, right? Commodities like oil and other like gold, etc., were at their highest peak during that time. Now, if you look at Muslim countries or where Islamic banks are based, most of them were oil-producing nations like the Middle East, right? Malaysia and Indonesia also have a substantial amount of commodities, which they underlying commodities like, for example, crude palm oil, gold, and whatnot. So there are two sides to the picture. Now, I'm not saying yes or no. I'm definitely saying that financial crises can be restricted in an Islamic economy, but can we completely eliminate them? Well, it's not that easy, right? Like I said, during the 2008 financial crisis, or during that period, we were going through a super cycle of commodities, especially oil. So that definitely played a part in its resilience as well. Right. Now, the challenge is obviously going forward for the Islamic finance industry is that with oil at a low, at this low, what is the response, or how will that affect the Islamic finance industry? Currently, obviously, there are liquidity issues, but currently it's doing fairly well. But the challenge is to see how it progresses forward with this. Another thing which it helps with is financial inclusion. Now, if you look at the graph on the left, right, or the financial inclusion graph. Now, what is financial inclusion? Now, there are a lot of percentage of the population, especially in developing countries, who are unbanked, right? They don't have enough income for banks to have a profitable consumer base. So the banks generally ignore them. They can't go for a loan. So, for example, it's a very small bread producer in Indonesia or Pakistan, a small farmer in Pakistan. If he or she goes to a bank for a loan, the bank just would not entertain them because they're unbanked. But we have, according to as this graph shows, there is definitely a positive correlation between financial inclusion, high numbers of financial inclusion, and economic development. Right? If you look at all the developed economies, it's where there's a high level of financial inclusion. Right. So Islamic finance, especially in Muslim countries, has helped increase or the number of people coming into the organized financial system or the financial bracket. I remember I was speaking to one banker from Pakistan who told me that when they started Islamic banking, people would literally come with stacks of money, right? But it was like with mud on it and everything. And when they asked, where are you getting this money from? They used to say, like, we don't believe in interest-based banking. So what we do is we dig up holes, right? And we put our money there for safekeeping. True story, right? So it has increased financial inclusion. But what's more interesting is how we can leverage technology and Islamic finance to reap better benefits, right? What do I mean by that? So if we look at the Muslim demographic, so the Muslim population is 1 billion plus strong. But if we look at the Muslim demographic, two things stand out, right? Firstly, majority of the Muslim population are millennials, right? They're young, under 30, or at least under 35, majority of the population, right? So which means they're tech savvy. They've grown up in an era where they're okay with technology, right? The second is, unfortunately, majority of the Muslim population lives in rural areas, or are mostly living in underdeveloped areas. Right. So how are we leveraging technology for Islamic finance? So if I look at the second graph, it shows, by the way, believe it or not, the most advanced fintech country in the world is Kenya. They've leveraged off fintech and technology and e-payments superbly well, right? And they've used it. And this graph shows exactly that. They've got a payment system called M-Pesa, right? And if you look at the red line, right, it shows that it took radios 20 years for 80% of the Kenyan population to have access to a radio, right? But it took almost 3 years, just 3 years, for this e-payment system called M-Pesa for 80% of the population to have access to this system, right? So you've got radio, which took 20 years, if not more, almost 20 years, for 80% of the population to have access to it. And here you have a technology, using technology, a payment system, which literally took 3 years for 80% of the population to accept. Right? So, and if you look at it from an Islamic perspective, firstly, you have millennials who are okay with technology. B, you have people who are living in the rural demographic, right? Your demographic who are living in rural areas, right? So it's very unlikely that a Citibank would go and open a branch in, or Citibank or HSBC or these big banks, to open a branch in a village in Pakistan, right? Because it does not, and it's not anything bad, it just does not make financial sense. It's not viable enough for them to invest that money in a village in Pakistan. But if you have a technological infrastructure which you can use through a mobile, right, you don't need a branch, right? You can leverage off technology. They already have a phone, right? And the technology is being used irrespective of if you're a city dweller or a rural if you live in a village, right? Wherever, in any developing country. So that, and secondly, if there's a big push for crowdfunding as well. One of the biggest areas in fintech is crowdfunding, right? And if you look at crowdfunding is basically you get a group of people who invest into a project, right? A partnership-based project financing, if you may, right? Or venture capital financing, And what does this reflect? This reflects Islamic principles as well. Like we mentioned, mudaraba, for example, or even musharaka. You can get a lot of partners who invest, a little bit of amount into funding different projects, right? So this can be based on Islamic contracts as well. So there is a case for leveraging technology, and there is a definite case of Islamic banking increasing financial inclusion. What are the advantages for governments? Right, now we move on to the advantages to government. Those are advantages as the economy as a whole. But from a government's point of view, well, if we look at the trend in developing countries and countries who are moving into the next, or taking the steps toward being developed, well, the population is increasing, right? And there's a need for infrastructure, right? There's a definite need for infrastructure. The population increasing and the middle class is also increasing, which is a good thing, but that increases demand for demand for infrastructure, demand for roads, demand for more energy, and all those things. So there's a definite demand for more infrastructure in even Muslim countries, right? All developing countries, but even Muslim countries, like we mentioned earlier, most of the developing countries, the population is Muslims, but there is a definite economic increase of the middle class in these countries, right? So you've got to push for infrastructure, but there is also given the fact that oil prices have dropped and commodity prices have dropped, there is a strain on the governments of many Muslim countries, of financing, of liquidity, how to finance these infrastructure projects, right? Be it Kazakhstan, be it the Middle East, be it other countries, there is definite strain on how do we finance these projects, infrastructure projects. And these also link into the UN Sustainable Goals Initiative, which says that infrastructure is one of the most important pillars of these sustainable goals, right? So how do we tackle this using Islamic finance? Well, Sukuk issuance. Sukuk is an Islamic bond which can have any underlying Islamic contract, but a Sukuk issuance is one of those things which can help this governments overcome this. I mean, even non-Muslim governments, governments in non-Muslim majority areas have leveraged off Sukuks for infrastructure financing. For example, the United Kingdom, Hong Kong has done it twice, South Africa, Luxembourg, Germany was the first country in Europe to leverage off a Sukuk for infrastructure financing. Nigeria has done it, and many other African countries have done it, where the Muslims might not be in a majority. So a lot of even non-Muslim governments have leveraged off Sukuks to finance infrastructure projects. Right? One of the advantages, obviously, is there must be an underlying real asset or tangible asset or a business venture. Right? This can help. Sukuks can help governments. Get foreign liquidity, because Sukuks can either be issued in a local stock exchange or whatever, or they can be issued as a foreign stock exchange. For example, the London Stock Exchange has a lot of Sukuks being issued. Dubai has a lot of Sukuks being issued. So it depends. It can help governments attract foreign liquidity, foreign investment as well. In fact, one country that does this exceptionally well is Indonesia. Indonesia is the largest issuer of foreign Sukuks, right? And it's raised about $7 billion in financing, in Sukuk financing, if not more, right? And they've financed from railways to bridges to power plants using Sukuks, and they've all done it through Sukuks issued in foreign markets, dollar-denominated Sukuks. Now, Sukuks can be obviously local currency denominated as well, depending if you want to hedge against, if you think that your currency is unsustainable in the sense that you don't want to pay your investors in dollars, you can obviously have local currency denominated Sukuks. But Indonesia has taken a lead in attracting foreign liquidity using Sukuks, foreign investments using Sukuks. But there are also other examples of socially responsible investments, of socially responsible Sukuks. Right? For example, the World Bank, issued a $500 million Sukuk, immunization Sukuk, where it funded vaccination programs. Right? And this was actually great because it's actually in line with Islamic principle of social responsibility, social justice, but you're raising money and your investors are making money as well. Right? The state of Osun in southwestern Nigeria issued Sukuks to fund the development of the building or construction of schools. So Osun State has done that, right? So there is definitely a case where you can make money and also do good, right? And you can leverage off Sukuk as one instrument that can help you in doing that. Now we go on to the advantages of Islamic finance to institutional level, at an institutional level, right? And we look into, so if you look at the Islamic finance industry or Islamic banks, we've seen that over the past decade, if not more, or since inception, in fact, one thing that Islamic banks have faced is, they've got excessive liquidity, but they don't have enough avenues to invest them, right? Some of the avenues might be a commodity murabaha, which is an instantaneous transaction, back-to-back transaction, a commodity murabaha or tawarruk. The argument for or against, I won't delve into at this time, but there's definitely some people are against it. Some people, for example, a tawarruk, organized tawarruk. OIC Academy is against it. IOFI permits it. IOFI, the Accounting and Auditing Organization for Islamic Financial Institutions, but it permits it in very certain circumstances. But that's a discussion for another day. All right, so you've got commodity muraba, you've got wakala bank placements, and you've got your sukuks. These are the three major options you have, right? And sukuks, obviously, there's definite issues of tradability. You can't issue sukuks; they're not enough in the market, and they're mostly long term. So banks have always had an issue of how to, use this liquidity in the most effective manner, how to find Sharia-compliant ways or avenues of investments, which are also fairly less risky for liquidity. So banks, counter to their conventional, opposite to their conventional counterparts, right, who sometimes have liquidity issues, Islamic banks have had excessive liquidity and not enough avenues to invest it, right? And how do you deal with this? Right? And one of this, obviously, the pioneers of this concept were a dinar standard, right? But one of the things which we've had discussions with a lot of banks is the global Islamic halal economy, right? Why isn't there a push for investing in halal businesses, the greater halal economy? So Islamic finance is just part of the global Islamic economy. They've got halal food, they've got halal clothing, we've got halal clothing, we've got tourism, we've got media, pharmaceuticals, cosmetics, you name it, right? Just to give you an example, the largest exporter of halal beef is Brazil, right? Who've leveraged off the halal economy, they've made money, the Brazilians have made good money. In fact, the third largest exporter of halal beef is India, right? And in India, local consumption of beef is banned due to religious reasons. They ban local consumption of beef, but they've leveraged off the halal economy, they export a lot of beef. But you've got Islamic banks who've just ignored the halal sector, right? There's a lot of demand in this sector, there's money to be made, but these are being unfortunately ignored, right? This can also lead to unlocking the, providing financial assistance or access to millions of SMEs or micro entrepreneurs, right? So you're not only making money, but you're doing good. You're kickstarting economic activity, right? Because these are mostly SMEs or even micro entrepreneurs who do this, right? So there's the definite case of leveraging off the halal economy, which Islamic banks have largely ignored. For example, I'll just give you a case study. South Africa, not a Muslim majority country, has really leveraged well off the halal economy. I mean, the country hopes to exports will increase by 31 billion. Halal exports will increase to 31 billion by 2020. Now, South Africa exports halal meat and whatnot, and other products to both Africa. It caters for the African market and the Middle Eastern market, right? For example, the Burger King's second largest halal patty producing factory is in South Africa. So they're leveraged off it really well, and there are definitely other advantages, examples of where the halal economy has been used for the advantage of the financial institution. Right. And this concludes my presentation. I thank you for your time, and if there are any questions, you can contact me at mkhalid@bibf.com. Again, I'd like to thank AIFC for this opportunity and wish them luck for the future. Assalamu alaikum wa rahmatullahi wa barakatuh.